Hi everyone, my name is Adam Campbell. I'm a junior finance major at Howard University, and welcome to a student's intro to alternative investments. In this series, we get the chance to learn directly from today's leaders in the alternative investment industry. In this episode, we'll be exploring real estate investment strategies and due diligence in alternative structures with Mr. David M. Sengstock, president of Mick Law. Thank you for joining us, David. Can you tell us a little bit about yourself?
You bet, Adam. I appreciate you having me. This is my first time doing one of these podcasts. This is going to be a great opportunity to get to know a little bit more about each other. I am the president of Mick Law. We are a due diligence law firm based in Omaha, Nebraska. So I would say 95% of what we do is due diligence on alternative investments. So it's never going to be the public companies that you're seeing on NASDAQ or Dow Jones. Those are all publicly traded companies. We're talking about private companies raising private capital, and that's basically what we're looking at on a day-to-day basis.
You mentioned due diligence. Is there anything in the markets right now that you're seeing in the alternative space that is particularly attractive?
Thank you, Adam. So it's always a cyclical type thing when you're looking at investments. So a couple years ago, interest rates went crazy. They were a lot higher than what people expected. Cap rates, which is basically what properties are selling for, were all over. So buyers and sellers had a disconnect. They really didn't know what to expect from each other. So there wasn't a lot of opportunities for them to find a good purchase or find a good sale. Nowadays, I think you're starting to see buyers and sellers come together a little bit better on pricing. So I think opportunities that do not have financing, we've seen a lot of, because you still have market financing problems where you're overpaying. It's very expensive for financing property. So a lot of opportunities, you're seeing groups go without financing because then they have a little bit more leeway on when they want to dispose of an asset, how long they want to hold it. So I would say those are some good opportunities.
And on the financing piece, what factors could bring the sellers and buyers closer together?
Well, financing's really kind of outside of their purview. They don't have a lot of decision on what's going to happen from the banks and what they're going to offer as a lending rate. But I think what you're seeing sponsors do is maybe there's an opportunity to take a property and put lesser financing on it, where they're still building a financing opportunity within that overall investment strategy, but taking a lesser loan to value, which then they can sometimes make the cash-on-cash returns to investors look a little better. So there's a lot of that, and I've always talked, probably since I've been doing this for 18 years, and that's getting long-term set-in-stone debt versus you see some groups might take a look at opportunities to do some short-term financing and then have to do a refinance in a year, or they might be subject to fluctuations in the market. So that you never know the direction you want to go, because you never know the direction on what your financing term might be. So if you can get it locked in for a period of time, you're in a better situation to know for the long term what you're getting into and what the expectation should be and what you're going to owe on the lending side.
Thank you for providing some insight on that. To touch a little bit more on your background, can you talk about when you're evaluating a real estate investment opportunity, what are some KPIs or frameworks that you're looking at to drive returns?
There's basically two parts of every due diligence when you're looking at an opportunity. The first is actually the group that's providing the opportunity. So we'll call them the sponsor or the asset manager. And then you have the actual investment itself. So a very important thing, because anyone can say, here's a return we think we're going to be able to project to you over a hold period of, say, 5 years. It's a whole other thing if they can actually get to that number. So as a due diligence officer, my job is to make sure that I can see the expectations that the sponsor's putting in their memorandum, and then determine on an individual underwriting basis, a third-party independent side of things, that these numbers might actually work. So I would say the first thing to look at, outside of what you're going to just see the sponsor say in their offering memorandum, would be looking at the sponsor and looking at the sponsor's prior performance. Now, obviously, it's not indicative that the offering you're looking at is going to be just as successful, but seeing what a sponsor's been able to do over a period of 10, 15, 20 years is kind of telling as to what you can expect that sponsor, at least the time they're going to put into the offering, into the opportunity. So all that kind of comes into sponsor and their ability to kind of been around for a while, to maybe cycle through some ups and downs in the market. That's a really important thing. And so you're not going to necessarily see that in the offering that you're looking at when it's a specific real estate investment, but digging into that sponsor is going to be really important. I think another one would be a development sponsor. Let's say they're developing a multifamily, a 330 unit multifamily property in Canton, Ohio, we'll say. Do they have experience developing in that area? Have they done it before? Are they able to show that they've done it before? And have they been successful with doing that? It's all important, because what you see a lot of times sponsors do is they see where the money is going, and then they kind of follow that direction on what they think they want to be doing. But that may not be necessarily what they're really good at.
So when looking at these precedent sponsor transactions, what are you doing now to figure out where the puck is going and how to capitalize off that? How would that align with your strategy and your clients?
So my clients have a pretty good idea of what they see the market at, meaning I'm talking about from the broker-dealer or the investment advisor side. They know what their clients want to see, meaning their investors. So they're really going to spend a lot of time understanding whether or not a certain sponsor can fit that style of investment that they think their investors want. So our job is then going to really be to dig deep and determine whether or not these groups can be successful, and have they been successful, and what does it look like on a long-term hold basis.
Kind of on the same note, how would you weigh some of the more qualitative factors of a business, like sponsor track records or the market dynamics, against more of the quantitative analysis, like projected cash flows or debt structures?
So they're both very important. One's going to give you an idea of what they're anticipating this specific investment to do, and the other one's going to give you an idea of how they've been successful in the past. Although, like I mentioned earlier, looking at a sponsor's track record may not necessarily be indicative of their ability to continue that in the future. It's going to give you a really good focus on what they've been doing over the years, and whether or not they can continue that success would be up to them going forward, but it's going to give you a good viewpoint on it. So that's really important. The financing terms, you mentioned that, and that's one important thing to note. A sponsor that's established, that has really good working relationships with lenders, has a way better opportunity to get financing structure and opportunity that groups that don't have those relationships have. So a sponsor that's more seasoned is more likely, not saying that another group wouldn't be able to, but they're probably going to be more successful getting the financing that'll work better for what they're trying to do. All because the banks understands who that sponsor is. They've probably done work with them before, so they're willing to do some things for them that maybe they wouldn't with a group they have no historical basis to work with. I think another thing to mention would be a sponsor has to know, and they have to understand the market, they have to understand the sub-market, and they have to be able to kind of do their own cash flow underwriting on what they think is going to happen over a hold period. If they don't have that experience doing that, or they haven't really worked in that specific sub-market or that market, it's kind of something to at least go off in your head. I'm not saying it's a red flag, but how about a light bulb going off, right? That maybe these people or this group is, maybe they're changing their strategy away from what they're really good at. So that's something to be thinking about when you're deciding whether or not this is an opportunity you'd want to put your investor clients in. And then finally, and it's kind of important, it's a little bit off of what you said, but we've really been seeing sponsors concentrate on it now, and that is looking at how the property is going to be reassessed for real estate tax purposes after they acquire the property. A lot of times sponsors were just running with, here's what the current real estate taxes were, we're going to underwrite it the same for the first couple of years, not understanding what that municipality or that city might be doing on the assessment side of things. And that can be a big difference. If the last time it was assessed, it was at 20 million, and now they just bought it for 30, that could be a big difference. So if they're not underwriting that increase in the real estate taxes, it's going to really put a damper on their ability to pay out investors' cash flow on an annual basis that they projected within their memorandum.
When sponsors underwrite, how much do the market conditions or the regulatory changes that we may see in the administration alter the investment's potential?
The sponsor has to understand those things going forward, and they have to understand when they're putting together their model how those things might change. Some things they may not have a lot to do with, right? If there's one administration in place and then 3 years into their whole period of an asset, things change. They may not have a lot of say into how that's going to pan out. Overall, I think it's the sponsor's going to try to use conservative underwriting to make sure they're accounting for things that may happen during that hold period. So I mentioned the real estate taxes. That's one thing, but it's also understanding the appropriate assumptions. For instance, occupancy assumptions, vacancy assumptions, rental rate growth, operational cost growth. How does that all play out when you're looking at an asset? Because if you're underwriting, small fluctuations on how you're underwriting these different assumptions can have a drastic difference over that whole period of time that you might be holding that asset. So understanding what's going to happen is really important. And there's a lot of ways in which they can do that. I mean, there's a lot of just services that these sponsors will pay for that'll allow them to get market and sub-market data, that'll allow them to get a lot of data as to what they think is going to happen in that market as it relates to new growth. For instance, if you're buying a property and it's kind of unique, and let's say the municipality or the county doesn't really want to develop more of that type of asset, makes your asset a little bit more valuable because you're not going to have that competitive set come in as new development. So all these things can be found, but it's all through subscription services, and they can get that. And it's going out and asking and talking to local government officials to kind of see what their viewpoint is. As you know, there's some municipalities, some cities, some states that are more pro-growth than other ones. So being in those areas obviously is going to hopefully give you a leg up on doing that. And there's other places where there's a lot more hoops and a lot more hurdles you have to get over to get to that same spot. So understanding what the government in that location is going to do, or at least have a good idea what the expectations of them may be doing, is going to be really important when you're deciding on where you want to develop a property or where you want to buy a property.
When assessing the competition, are there any niche indicators that you may be looking at, whether that be macroeconomic factors that give you an advantage over your peers? It could be economic data or just anything you're seeing in the markets that others may not be using.
It's always a good sign when maybe they're raising 90% of the capital from investors, but maybe the company is putting in 10% of their own money. So now it kind of tells you their skin in the game. They want this investment to work just like the investor wants it to work. So if the investors don't make money, they don't make money. Better alignment of interest that you would expect to see. And when you see that, that's usually a really good thing.
With increased interest in alternatives, what new trends or risks do you believe are underappreciated in today's market?
Well, a very important thing is when times are really good. So think about just after COVID's a really good time to look at it, because everything kind of just really ramped up for about 2 years. People were buying like crazy. People were selling like crazy. And anyone can kind of make money during those times, right? But it's those other times that are a little bit more difficult. So when times are really good, you start finding that groups come into the market that are unqualified. They see the money and they see that these other groups are raising capital. So they say, I'm going to do it too. So they come into the market with not nearly the qualifications of maybe another group, but because these groups are trying to look at raising capital, meaning the broker-dealer community that are trying to, they see the opportunities and they sometimes will go for an opportunity that exists and is raising capital that may be less than what some of the other opportunities are out there. So really doing a real deep dive look at that group and how long have they been around and then should they even be here. Following the money is obviously an important thing too. There's always a thing that my boss told me back in 2006 when I started working with him, and that's following the money. So if you start saying who's putting the money into the deal, who's taking the money out, and if the sponsor's receiving compensation, is it incentive-based? So it's those three things. That's the first one, kind of goes with the sponsor putting money in with the investors. So if they're putting money in with them, we expect the returns for both of the investors and sponsors to be the same. When you start talking about taking money out, if the alignment isn't there, where the sponsor's putting in less money, but they're getting a greater return, or the cash flowing to them at maybe a number or a percentage that doesn't really match their investment, that's an issue. And then the compensation is a big one, because if you're just looking at a memorandum or a sponsor's offering, it gives you all kinds of numbers. Here's the different fees they're going to get. You have to know whether or not those are market. Are they over market? Are there just way too many fees where it seems like they're just dragging the property's operational benefits for the investor down by dragging all these fees and costs that are coming out? It's a lot of fees. If it's fee heavy, it's not going to work out as well. So you really want the sponsor to understand that they can take some fees. No one's working for free, but it also has to be maybe after the investors are getting a return of money, after they've gotten some cash return on an annual basis, and those types of things. So that's just things to be looking at when you're seeing kind of markets up or down, and kind of evaluating those as being important when you're looking at each structure of an offering.
This has been an incredible display of just the wealth of knowledge that you have within this space and being able to break it down to me and the listeners. Just in closing, what advice would you give to students seeking to build the analytical mindset needed for this career and for evaluating the alternatives industry?
Well, thank you, Adam. I've had a pleasure doing this. First thing, follow the money. That's always the first thing you can be looking at. The second thing I would say is always be looking at an investment from the eye of the investor. So even for me, even though my representation isn't for the investor, but for maybe the broker-dealer investment advisor that I represent, I put myself in that investor's spot, in their position, say, does this all make sense? Am I getting a return that makes sense for the risk that I might be putting my money into this deal? If the risk is high, the reward should be high, right? So does that all make sense? And then the third thing would be, when you're looking at a sponsor and you're looking at their underwriting model, you can trust it, but you have to verify it. So they're going to tell you one thing, and that's great, but you have to have the ability to do your own underwriting and your own cash flow statement and use your own assumptions and see, where does this work out maybe in a non-so-perfect scenario? And how does that play out for what the investors are going to get? Because if you just listen to what they say, everything looks like it's all roses. Everyone's going to just make a ton of money and you can't lose. Step back a little bit and look at what could happen, give it more like what they call a base case scenario, or even a really stress scenario. And how does that work out? Because sometimes investors can still make money in those other scenarios. They just might be not making those really high returns the investors or the sponsors using for purposes of a lot of times selling their product, telling you something maybe that's not quite realistic given market conditions. So those are all things that I think to look at, and you can continue to look at as you go through this process.
A big thank you to Mr. David Sengstock for sharing your time and insights with us today. And thank you for everyone tuning in. We hope you enjoyed this conversation on real estate investment strategies and due diligence and alternative structures as much as we did. If you found this episode valuable, don't forget to subscribe so you don't miss future conversations. We'll be back soon with more expert insights and student perspectives on alternative investments. Thank you, David.
Thank you, Adam.